can't believe we're doing another episode of ISG's Imagine Your Future. How are you today?
I'm well. How are you doing?
You know what? I'm doing awesome. It's been a great week so far. So we've got a really cool episode. We're going to go in and really deep dive a little bit into the private equity world with our very own Chris Reeves, who's a director in our private equity practice here at ISG. So we're excited about that. And welcome, Chris.
Thank you, Steve. And thank you, Karen. Excited to chat about private equity today. They've given us a lot of good information lately. So it's a fun topic to talk about.
Well, we're super excited to have you, Chris. So thanks. Before we talk about the PE space and what we think is going to happen in 2022, I was wondering if you could give us the state of play for 2021. So I was doing a little bit of reading ahead of today's session, and I learned that PEI, which, is the name of a province here in Canada, but in this case, it stands for Private Equity International. They had a fundraising report that said at least 733 billion with a B, was raised by PE funds globally, and that the market had surpassed every previous year on record. 40% of that number was raised in North America, and I have to admit to being a little surprised at how robust last year was. So what do you think was going on?
Yeah, Karen, fundraising is a kind of a good place to start when trying to talk about private equity. The numbers are so incredibly big. And actually, as I was putting together some notes for this conversation, I realized how many times I use the word trillion as a metric to talk about some of these private equity numbers. And that's a big number, but if you use it often enough, it kind of loses some of its power. But just to give you an idea, I think fundraising is the underlying driver for all of the activity. It's, you've seen investors contribute more capital because they've really enjoyed the returns that private equity has been able to deliver. And so they're just bringing more money to the table. And that number that you mentioned, that 700 billion, is going into the coffers of the private equity firms, which already have quite a bit of uncommitted dry powder in their coffers. And so you've got just some of the figures I was looking at to give you an overview. In the U.S. alone, U.S. private equity has over $1 trillion of dry powder, uncommitted yet, undeployed, I should say. Probably that number is $2.3 trillion in dry powder. So a lot of capital just sitting and waiting in the wings for private equity to figure out what to do with. And so that's really, the underlying push. To talk about 2021 for a little bit, just to set the framework for what we're going to talk about and what we'll see in 2022. You had a record amount of deal activity in private equity. In just the U.S. market alone, you had over 8,600 deals executed in 2021 for a total deal value of over $1 trillion. You had a record number of exits last year in the U.S., 3,800 in 2021. And you've got these big firms like Blackstone and Apollo who are kind of chasing the 1 trillion mark in assets under management, trying to beat the other one to the top. And Blackstone announced last year that their original timeline to hit the $1 trillion assets under management mark was 2026, but that was pulled forward to the end of this year in 2022. So you'll see Blackstone hit $1 trillion in assets under management, which is larger than about all but 20 GDP numbers from countries around the world. So just an insane year of activity last year in 2021. The main factors, I think, that set up the pace of activity were kind of two things. One, the pandemic of 2020 just created a pause, really more than a pause. It killed the deal-making activity in 2020. And so a lot of the deals, 2020 was predicted to be a strong year for private equity prior to the pandemic. And so pandemic hit and all of the deals either were punted into the back end of 2020 or most of them really delayed until 2021 or didn't pick up at all. And so you had sort of some catch-up deals in 2021 from the pandemic. And then you also had some deals that were pulled forward that were maybe farther out on the horizon, and they're wanting to pull them into 2021 and the first part of 2022. And that's due to trying to get ahead of just macroeconomic trends, inflation, some upcoming tax changes that are likely going to impact private equity. And then, of course, rising interest rates. And so it made for a very active and just crazy year in 2021. And that's kind of setting the stage for what we'll see here this year.
Yeah, Chris, I love the term dry powder for so many reasons, but I get what that really means as you think through it. But with that much money chasing sort of different markets, and whether that's tech or meta, or even seeing it in service provider acquisition, like especially in the digital engineering space, how do you see that really impacting maybe some of the evaluations and some of the deals that are out there?
Yeah, that's a great point. So there's a couple of factors playing into private equity where you're seeing the valuation multiples of acquisition targets just skyrocket. One is the amount of dry powder, to your point, that is out there and available. And the second factor is just it's highly competitive right now in private equity as compared to even 10 years ago. The number of firms with big money is large. I mean, just from that $1 trillion of dry powder that we talked about, there are 25 of the top firms that have 500 billion of it. And that also means that there are the other 5 billion spread out among a number of smaller, I use air quotes, smaller mid-market private equity firms with another 500 billion in dry powder ready to execute. And so, where 10 years ago, you may have had 3 to 4 firms bidding on an acquisition target. Now you've got 20 to 30, and you've got a number of mid-market firms that are willing to take maybe more aggressive risks and more aggressive play than what you would have seen even 10 years ago. So, there's no real bargain hunting anymore in private equity. All of the hidden gems have been exposed and acquired, and it's sometimes exited. And so there's just, a lot of the targets that are out there now are just really high valuation multiples. So it's changing the way deals are done. And it's challenging private equity firms to still put that uncommitted capital to work, but to do it in some creative ways. So you're going to see a lot of creative deal making. And we'll talk about some of that a little bit later on, but you'll see some of play as far as investment strategy goes. I don't think it's not the same area that you might have seen 20 years ago where a private equity firm acquires the company and then just does some financial engineering and makes a few improvements and then sells in 3 to 4 years. They're having to get very creative with their investment strategies and go after sort of some atypical private equity acquisition targets. And then they're also getting
to see the private equity and the VC space sort of colliding here as they're both trying to find value as they go forward. And they traditionally had sort of different portfolios, haven't they, or different targets?
Yeah, absolutely. And you're still seeing a rise in growth equity and venture capital. That's clipping off at really the same rate as the buyout market. So you're just seeing some more creativity. I'll give you a good example. There's a mid-market firm called Francisco Partners that just in January acquired the data and analytics units from Watson Health. And they're using that company as a platform. What they end up doing with it, what they end up bolting onto it, I don't know. But that's a interesting play that I don't think you would have seen years ago, where a heavy tech firm with a big data play could be very disruptive in healthcare. But what is the private equity's vision for that company? I don't know. It's going to be interesting to watch. But I think that's the kind of atypical deal making and target that you might see in 2022.
Awesome. Well, amazing overview. That's such a great space. Give us a sense on sort of what do you see the top trends going into 2022 then?
Yeah, we thought about this, and I think you'll see a lot of carryover. 2022 is going to be interesting. I don't think it'll be the same pace, frenetic pace of 2021, but I think you'll start to see some trends maybe return that you haven't seen in a while. And one of those is the kind of return of the mega deal or the big buyout, which we really haven't seen since 15 years or so since the financial crisis. I think you'll see the bigger firm trying to play and look for some targets that have in the past been maybe pried out of private equity's world. So you'll see them coming together in what's called a club deal, where multiple firms work together to commit capital and buy a big acquisition target over 10 billion. And you saw that happen last year, middle of the year last year, when Blackstone and Carlyle and Hellman and Freeman came together and purchased Medline, the medical supplies distributor, for 34 billion. So that was the first time that's been done in a long time. And I've seen some analysts predict that is going to be the transaction that kind of opens the floodgates for these mega deals, particularly because it's the only space, or it's the space where only the big players can play. It's going to price out a lot of those mid-market firms that are competitive. So I think that will be one of the major trends that we see going into 2022.
So what about the middle tier firm? If, mega acquisitions take mega dollars, what do the mid-tier firms do? What will they be looking forward to this year?
Yeah, it's a great question because they've obviously got the same pressure from their investors. They've got a lot of capital. So I think you'll see they'll be very creative in their deal making, just like that IBM Watson transaction from Francisco Partners. I also think a trend that you'll see expand a bit is what's called the GP stakes strategy, which is essentially where a larger firm commits a minority investment position into a mid-market firm. And so you'll see some players that do that today. Blackstone has a division that focuses on GP stakes. Dial is a major leader. Goldman Sachs has the Peters Hill Group. And so for the large company that's committing a minority investment, it's a situation where they get to access a fund that is already mature and at scale and being actively managed by a management team. And the assumption is that it's performing well. And so they get to tap into that growth potential and diversify their portfolio a bit. And then the receiving mid-market firm gets access to a lot of capital and the resources of the larger firm. And so that just provides all sorts of flexibility and ability to go and expand the fund and look for new add-on companies, which we're seeing a lot of activity around that. But it's a win-win for both firms. And so I think you'll start to see that GP stakes model expand a bit. I wouldn't be surprised to see maybe some new players move into that space and try to set up some affiliate relationships. So that's a trend that I would expect to see expand.
Chris, it's so interesting. Karen and I love Professor G, or Scott Galloway. And last week on his blog, he really talked a lot about sort of the down market that we're going into. And I think he was talking broadly about the stock, cryptocurrency, everything. But he had a really good perspective that he thinks a lot of founder CEOs and, newer people in this space that haven't been through some downturns, he's adding a new word to their vocabulary called down round. And sort of his premise is that for the last several decades, it's grow at any cost, right? More raising, more hiring, more building. Don't worry about EBITDA. Don't worry about profits. And what we're seeing now is that there's been a big backlash on that, and that you do have to make a profit. You do have to have, margins, et cetera. When you think about the private equity guys and how they think through this, I suspect down round is important for them, even though it's more of a VC term. But what's sort of your sense on the space that we're going into?
Yeah, I think it's interesting. I've seen some predictions where private equity, will sort of follow some other investment trends into sort of a bearish trend. I don't know that I see that happening quite yet in early 2022, just because of what we talked about, the dry powder, uncommitted capital. The investor expectations are still there in spite of the headwinds that are certainly coming. And so I think you're just going to see that creative deal making, creative value creation theme continue to play out in 2022. So I think that's going to look like a lot of divestitures of well-performing business units, private equity looking into public sector for the high-performing, maybe differentiated business units that they can take private and use as a platform company and then bolt on complementary pieces to it. I think, it's a great market for that if you're the seller. And so I think you'll have a line of private equity partners looking to join you if you're willing to spin off a well-performing business unit. And you saw that last year. Western Union actually sold their business solutions unit to a relatively small private equity firm called Goldfinch Partners. And what they end up doing with that and creating will be one of the largest business-to-business cross-border payment solutions providers in the world. And so I think that is a good example of what you'll continue to see in 2022, looking for differentiated business units that can be pulled out and used as a platform company to add on additional components to build a new company. And one of the components that private equity is starting to look at now more than they ever have is the digitally enabled business unit. So what is the business unit or the company that they can stand up that will differentiate themselves via technology adoption or technology change in an industry that maybe hasn't been impacted in the past. And so I think, you'll continue to see that grow out. I think that you'll also see a focus on ESG throughout the remainder of 2022. This is a topic that really got brought up front and center last year, and now private equity firms are trying to figure out, what does that look like? So you have investors asking firms to consider not just looking for the best valuations and the best companies to grow a profit, but to also look for those companies who are doing the right thing and who are, impacting our world in a better way. And then maybe investing in those companies, prioritizing investment into those companies. And so you've seen some impact investing, some funds that are targeted specifically towards ESG companies who are doing good things out there in the world and investing in those companies. And then you're also seeing a pressure on the operations side of the private equity firms and the portfolio companies that they already have, is how do we start measuring ESG and the metrics behind it? And then how do we start making improvements for the portfolio companies we already have? And what does that look like? Those conversations are happening right now. I think that'll be a big play into 2022, and that'll be a continued focus from our private equity partners.
You got all my neurons firing right now, Chris. It's a really good conversation. When I was 2014, 2015, I actually did the strategy for Western Union Business Solutions, WUBS, out of DC. So that was really cool. And it's a great example, and even your digital example, is how organizations, whether they're in finance, retail, insurance, I'll even use examples like life sciences and Monsanto and Bayer, when they merged, there was a lot of carve-out activity. So I think you're right. I think the PE firms are absolutely looking for value. I almost wonder, and we probably don't have time to explore this, but as the metaverse really starts taking off and retail and others start really moving more towards the digital journey for buyers, do you start seeing more divestitures of their digital business units, if you will, similar to what WUBS went through, especially as you start seeing big revenue on the online side of it, and maybe start even thinking about brick and mortar, brand, and online sort of maybe being different things. It's just a fascinating space. So, Chris, thank you so much. This was just a brilliant conversation. You really took us on a nice journey. You clearly have some depth, and it's great to see that ISG brings this much insight into it. So thank you. So, Karen, you want to bring us home?
Of course, Steve. So first of all, Chris, thanks again. Private equity, venture capital, that's always been a bit of a mystery to me. And this was a really educational conversation. So I appreciate it. Thanks so much. For our virtual audience, we appreciate you for taking the time out of your day to give us a listen. And if you've liked what you've heard, you can get more Imagine Your Future episodes by downloading them from our website at www.isg-1.com/podcasts or by subscribing wherever you get your podcast content. As always, thank you for lending us your ears, and we can't wait until we meet again.